The Australian Accounting Standards Board is an Australian government agency that develops and maintains financial reporting standards in Australia for Australian entities in private and public sectors. The standards are legislative requirements for the business and they are applied to general purpose financial reports. Furthermore, the AASB developed standards are in requirements of the International Financial Reporting Standards, but AASB maintained the power of standard setting specifically relating to Australia. Accounting is the process of recording financial transactions pertaining to a business. The accounting process, including summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The financial statements used in accounting are a concise summary of financial transactions over an accounting report, summarizing a company's operations, financial position, and cash flow. The AASB defines conceptual framework and objective and concept for general purpose financial reporting. It asks AASB to develop accounting standards based on consistent concept assess prepared to develop consistent accounting policies and assess financial report user to understand and interpret the statement the standards. For example, comparability, verifiability, timeline, and understandability are the four inherent quantitative, which aims to improve the quantity of financial reports. The objective of financial reporting is to provide financial information of entities to users such as visitors, creditors, customers. The conceptual framework helps to achieve this objective. The four main financial statements are balance sheet, profit and loss statement, cash flow statement, and statement of change in equity. The main elements of balance sheet are assets, liabilities, and owner equity. The elements of profit are loss statements, consents of revenues and expenses. The elements of cash flow statement are operating, investing, and financing activities involving cash. The elements of statement of change in equity is equity, such as change in share capital, retained earnings, and accumulated reserves. 5. The accounting equation is the foundation of the double entry accounting systems. The equation is assets minus liability equals owner equity. The double entry principle refers to the concept that a financial transaction have equal and opposite effect is at least two different accounts. For example, its company buy a computer for 800 cash, it will be increased the set side of the company by increase 800 on computer, while the deduction of 800 asset by decrease cash by 800. The charts of account are a listing of name of the accounting that the company has identified it for recording transactions in these reports. The accounting circles is the process from identifying the accounting events to financial statement, such as starting with purchasing of a computer to record the purchase, the ban, balance sheet. Transaction 1 issues share for cash. The sections will increase cash accounts for 10,000 for the company and increase shareholders' equity for 10,000. The transaction will be recorded in general journal as debit cash for 10,000 and credit owners equity for 10,000. The transaction is then transferred to ledger account and the trial balance in cash and owner's equity. Transaction 2 borrows money from the bank. The transaction would increase both assets and the liability account by 5,000. The transaction would be debit cash for 5,000 and credit loan payable for 5,000. The change will then be transferred to ledger account and trial balance. Transaction 3 purchase for office equipment for cash. The transaction would have no net effect to total assets, liability, and owner's equity for the company. It is recorded as credit cash account for 5,000 and the debit equipment account for 5,000. Then transfer the change to it. Transaction 4. The transaction will increase liability of 1,200 and increase assets account for 1,200. The transaction is recorded as the debit cash account for 1,200 and the credit unearned revenues by 1,200, which is a liability account. The ledger account will then show debit of 1,200 for the cash account and the credit of 1,200 for unearned revenues account. Similar for trial balance. Transaction 5. The transaction will increase assets account for 10,000 by debiting cash account for 10,000 and increase equity account for 10,000 by creating service revenues for 10,000. Similar for ledger and trial balance. Transaction 6. The transaction would have no net change of assets, liability, or equity. It will be recorded as credit of 900 in cash account and a debit of 900 in prepared rent account, which is an assets account. Transfer 7, similar to Transfer 6, it will have no net changes for assets, liability, or equity. It will be recorded as credit of 600 in cash account and a debit of 600 in prepaid insurance account, which is an assets account. Transaction 8. The transaction will increase both assets and liability account by 2,500. It will be recorded as debit to supplies or inventory account for 2,500 and a credit of 2,500 to account payable. Transaction 9 and 11. The transaction will not be recorded as of at 9 October, but it will be recorded on 26 October. As the transactions happened on 26 October, it would be recorded as debit of 4,000 to salary expenses account, which is equity account, and a credit of 4,000 in cash account. Therefore, it reduced assets and equity account on 26 October.